There's an interesting moment that happens in the life of almost every homeowner. It usually happens quietly. No big announcement, no headline, no major life event, just a realization. At some point after buying a home, people start to understand that their house is not just the place where they live. It's not just where their kids grow up. It's not just the place where holidays happen or where they unwind after long days. It's also something else. It's a financial asset. And for many Americans, it's the largest financial asset they will ever own. But here's the strange part. We spend years teaching people how to buy a home. We teach them about credit scores. We teach them about down payments. We teach them about closing costs. But after they become homeowners, we rarely teach them what comes next. What does it actually mean to build equity? What should someone do once that equity exists? Should it just sit there? Should it be used? If it should be used, when does that make sense? And when does it become a mistake? Because the truth is that equity inside a home can be incredibly powerful, but it can also be incredibly misunderstood. Right now, across the United States, homeowners are sitting on an enormous amount of equity. I'm talking record amounts of equity. According to housing data, Americans collectively hold over $35 trillion in home equity. That's trillion with a T. That number alone should make people stop and think, because that means there is an extraordinary amount of wealth quietly sitting inside residential real estate. Most of it is completely unused. Some homeowners view that equity as a long-term wealth builder. Others see it as a safety net. Some, unfortunately, treat it like an ATM, and others never even consider accessing it. The difference between those approaches can dramatically change someone's financial future, because equity can be used wisely or it can be used poorly. And the difference usually comes down to one thing: education. Understanding how it works, understanding the tools available, and understanding the consequences of the decisions that follow. Today, we are going to talk about something that sits right at the center of that conversation: home equity. More specifically, we are going to talk about two financial tools that homeowners often hear about but rarely fully understand: HELOCs and HELoans. What they are, how they work, why they exist, when they make sense, and when they absolutely do not. Because these tools can open doors financially, but they can also create problems when they are used without strategy. So whether you are a homeowner trying to better understand the value sitting inside your house, or a real estate professional trying to guide clients more effectively, this is an important conversation to have. And that conversation starts right now. I'm Dustin Owen, and this is The D.O. Show. They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to The D.O. Show, where I teach the lessons life taught me the hard way. Now, before we get into the mechanics of HELOCs and HELoans, we need to start with a simple question. What exactly is home equity? Because the term gets thrown around constantly in real estate and finance, but a lot of people that I know personally, they never actually stop to define it clearly. Home equity is simply the difference between what a home is worth and what is owed on the mortgage. That's it. If somebody owns a home worth $500,000 and they owe $300,000 on their mortgage, they have $200,000 in equity. It's simple math. 500 minus 300 equals 200. But that simple number can represent a significant amount of financial power, because that equity represents ownership, it represents value, and in many cases, it represents opportunity. Over time, equity grows in two main ways. First, through your mortgage payments. Every month when a homeowner makes a mortgage payment, part of that payment goes towards reducing the principal loan balance of the loan. Now that is, unless they're on an interest-only loan, but very few loans are interest-only these days. That means the amount they owe slowly decreases over time. Second, equity grows through appreciation. When property values increase, the market value of the home rises. If the mortgage balance stays the same, but the home becomes more valuable, the amount of equity increases. Those two forces together can build wealth surprisingly quickly over the long term. That is one of the reasons real estate has historically been such an important part of wealth building in the United States. According to research from the Federal Reserve, homeowners have historically accumulated significantly more net worth than renters over time. Not because owning a home magically makes someone wealthy overnight, but because over decades, the combination of principal reduction and appreciation can be powerful. However, there's an important detail that many people overlook. Equity inside a home is what economists call illiquid wealth. That means the wealth exists, it has value, but it can't be easily spent because it can't be easily accessed. You cannot walk into a grocery store and pay for groceries with home equity. You cannot swipe equity at the gas station. You cannot pay your child's tuition directly with equity unless you access it. And that is where the conversation about home equity lending begins. When homeowners want to access the value stored inside their homes, lenders provide several tools to make that possible. Two of the most common tools are HELOCs and HELoans. And while those terms sound similar, they function slightly different. A HELOC stands for a home equity line of credit. Think of it as a credit line secured by your house. Instead of receiving a lump sum of money all at once, the borrower receives access to a line of credit that they can draw from when needed. For example, imagine a homeowner opens a HELOC with a $100,000 credit line. They do not receive $100,000 immediately. Instead, they gain the ability to borrow portions of that line whenever they choose. They may draw $20,000 this year, $10,000 next year, another $15,000 later. As they repay what they borrow, that credit becomes available again. This structure makes HELOCs extremely flexible. Most HELOCs have what is called a draw period. This period typically lasts around 10 years. During the draw period, borrowers, aka homeowners, can access funds as needed and may have interest-only payment options. After the draw period ends, the loan transitions into a repayment period. During that phase, borrowers begin paying back both principal and interest. Another important characteristic of most HELOCs is that they usually carry variable interest rates. That means the rate can move up or down depending on broader interest rate changes in the market, typically the Fed funds rate. This flexibility is part of what makes HELOCs appealing, but it also introduces risk. If interest rates rise significantly, the cost of borrowing can increase. That is something borrowers need to understand before using this type of credit. A HELoan, it works differently. A HELoan or home equity loan functions much more like a traditional loan. Instead of receiving a line of credit, the borrower receives a lump sum of money at closing. If someone takes out $75,000 on a HELoan, they receive that $75,000 immediately. From that point forward, they repay the loan through fixed monthly payments over a predetermined period of time. Most HELoans come with fixed interest rates. That means the payment remains predictable throughout the life of the loan. For borrowers who prefer stability and certainty, that fixed structure can be very appealing because they know exactly what their payment will be every single month. Understanding the difference between these two tools is important because they serve different strategies. A HELOC provides flexibility. A HELoan provides certainty. A HELOC is used when expenses may occur gradually over time. A HELoan is often better suited for large one-time expenses. But before anyone decides to access equity, the most important question is not which product to choose. The most important question is why. Why are you accessing the equity at all? Because not every situation calls for leverage, and leverage by definition always carries risk. Throughout history, some homeowners have used equity incredibly wisely. Others have used it recklessly. One of the most famous examples occurred during the housing boom, leading up to the financial crisis of 2008. During that period, many homeowners treated their homes like ATMs. They repeatedly extracted equity as home prices rose. They used that money to support a lifestyle that they quite honestly couldn't afford. Luxury purchases, grand vacation, new consumer goods. In many cases, the borrowed money did not create additional value. It simply financed consumption. When housing prices eventually corrected, those homeowners suddenly found themselves in a dangerous position. They had more debt tied to their home than what the home was worth. That situation became known as being underwater, and it contributed significantly to the financial instability of that period. That history is one of the reasons responsible lending practices today place much stronger emphasis on equity limits and borrower qualifications, but the lesson still matters. Equity can be powerful, but only when it is used intentionally. There are situations where accessing equity can genuinely improve someone's financial situation. One of the most common examples is home improvement. Certain renovations can increase the value of a property. Kitchen remodels, bathroom remodels, structural improvements, energy efficiency upgrades. According to research from Remodeling Magazine's Cost versus Value report, many home improvements return a significant portion of their cost to increase property value. When homeowners use equity to fund improvements that increase the usefulness or value of the property, that leverage can make sense. Other common use cases is debt consolidation. Credit card interest rates in the United States today are extremely high. According to the Federal Reserve, average credit card interest rates frequently exceed 20%. For someone carrying significant credit card balances, consolidating that debt through a lower interest home equity product can dramatically reduce interest costs. However, this strategy only works if spending habits change. Otherwise, borrowers risk creating the same debt all over again. And then the problem becomes worse. Another situation where equity sometimes gets used is investment. Some homeowners leverage equity to purchase additional real estate. Others use it to fund a business. Some investors even use equity as a part of a broader portfolio strategy. But these scenarios require careful consideration because whenever a loan is secured by a home, the stakes are high. If the investment fails, the loan still exists. And the collateral behind that loan is the home itself. That is why education and professional guidance are so important these days. For homeowners watching this episode, the most important takeaway is simple. Equity is not automatically good or bad. It is simply a financial tool. And like any financial tool, the outcome depends entirely on how it is used. For real estate professionals and loan originators, there is an equally important lesson. The role of a mortgage professional is not just to process transactions. The role is to guide people through financial decisions that can affect their lives for years. That means asking better questions. What is the client trying to accomplish? What are their long-term goals? Does this loan actually move them closer to those goals? Or does it simply create short-term convenience? Those conversations require honesty. They require patience, and they require professionals who care about outcomes, not just transactions. Because the truth is that many homeowners are sitting on equity right now and have no idea how to think about it. Some are missing opportunities. Others may be considering decisions that could create problems. The best thing any homeowner can do is start with a conversation. Understand the numbers, understand the options, understand the risk, because financial tools are only as effective as the strategy we put behind them. If you are a homeowner watching this episode and you are curious about whether a HELoc or heck, even a HELoan could make sense for your situation, the best next step is to speak with a qualified professional who can evaluate your specific circumstances. Through the Loan Officer Podcast Network, we can help connect you with experienced real estate as well as lending professionals who understand these tools and how they should be used. They can help you review your current equity position. They can explain the lending options available and ultimately walk you through whether accessing that equity supports your long-term financial goals or it doesn't. Because the goal is not simply unlocking the money inside your home. The goal is using that opportunity wisely. If you would like to explore those options, you can find more information in the description where we can connect you with a TLOP-approved professional who can guide you through the process. Thanks for joining us today, and we look forward to seeing you on the next episode.